Hi, and welcome to the Finbox Academy. In this lesson, you will learn everything you need to know about stock dividends. Are you ready? Let's start. A stock dividend is a dividend payment to shareholders made in shares instead of cash. For example, if you own 50 shares of a stock and the company issues a stock dividend of 10%, you will receive 5 additional shares. Stock dividends don't affect market capitalization or shareholders' wealth. A stock dividend increases the number of shares outstanding for a firm, but, as with a cash dividend, the stock price tends to decrease when the dividend is paid. Both cash and stock dividends are not a way to increase the company's value or shareholder wealth, but a way to distribute part of the company's wealth to shareholders. Stock dividends are more tax efficient than cash dividends. They are not taxed until the recipient sells the shares received. However, if there is a cash dividend option, the distribution is generally taxed even if the recipient doesn't sell the shares received. There are several reasons why companies choose to issue stock dividends, but the most common one is that they want to reward shareholders while preserving cash. Let's take the recent coronavirus crisis as an example. The crisis has been difficult for chain restaurant companies. Many have had to close restaurants completely, despite paying fixed cash costs like rent. With many countries still in lockdown and an unclear timeline for reopening, businesses need to be very prudent with their cash balance. This is what happened to the world's largest independent McDonald's franchisee, Arcos Dorados. With nearly 2,300 restaurants, the company has the exclusive right to own, operate, and grant franchises of McDonald's restaurants in 20 Latin American and Caribbean countries and territories. Due to the COVID-19 pandemic, the firm has cancelled the 2 planned cash dividend payments for 2020. Instead, it plans to distribute a stock dividend of 1 share for every 75 shares held by its shareholders. As discussed, stock dividends are beneficial for both businesses and investors, since they provide greater flexibility while enabling companies to reward shareholders even in challenging circumstances. Distributing a stock dividend offers several advantages. Receiving stock dividends is much better than reinvesting cash dividends after paying taxes, since they are generally not taxed until the recipient sells the shares received. Stock dividends enable companies to reward shareholders even in unexpected crises, such as the coronavirus pandemic. By issuing a stock dividend, firms can save cash and extend the runway. Stock dividends have some disadvantages too. Under challenging circumstances, companies can distribute a stock dividend to save cash. The market may perceive a stock dividend as a warning sign that the company is facing financial troubles and react unfavorably. If you are an investor seeking passive income, a stock dividend may not fit your needs. Passive income investors are looking for, passive income. They want to receive the cash directly in their bank account without having to sell shares and reduce their ownership percentage. You can find the best dividend stocks using the Finbox stock screener. It covers more than 100,000 stocks worldwide and supports more than 1,000 metrics. What's more, you can also create custom metrics after exporting the results to Excel. The best part? You can use it for free forever. Before you leave, don't forget to subscribe to the channel, because in the following days, we'll publish new videos that will help you learn everything about dividends for free. See you at the next lesson.